Thanks, Justine. Again, want to thank Justine and Terry for hosting this event, and appreciate everyone coming out tonight, and definitely for the food and the hospitality. It's been great. So tonight's topic is taxes, what you can do before year end to minimize them, and as well what's new for 2016. So what I'm hopefully going to do is go through some items that you need to think about for your 2015 year. A lot of things that you may have heard before, but just to refresh your memory and make sure that you're not missing anything. And the new for 2016 is, of course, due to the change in government. There our new federal government, led by the Liberals, has indicated that there are going to be changes to the tax policies and that. So we're going to give you an idea of what is coming down the road and what you may be able to do to be ready for those. Okay. So getting ready to file your 2015 tax filing. Definitely ask questions as we go through. Don't hesitate if something's not clear or is confusing. Please just let me know and I'll go through it. But with your 2015 tax filing, I'm sure your accountants always tell you, but advanced preparation is key. It's always easier to have the information ready and do it as you get the information, rather than in 3 or 4 months trying to think back what you did throughout the year and where your documents are. And the main thing to think about is if you get ahead of time, generally taxpayers are allowed to deduct all reasonable expenses incurred in the year for the purpose of earning business income, unless there's a specific provision in the Income Tax Act that prevents that deduction. So we'll go through some of that, but so you want to make sure you're thinking about your activities and your expenditures, and do they relate to your income and to your business activities? And asking your advisor, should you be including this in your year-end information? Because a lot of times you can deduct some of those things. So, are you claiming all your available business expenses? We get a lot of questions throughout the year, and especially at tax time. What can you deduct and what can't you deduct? So I'll go through some common things that you should consider and make sure that you're not missing. So club fees. One of the main questions we get a lot from a lot of our clients is, can I deduct my golf dues? Can I deduct my ski club? Membership dues paid to a recreational facility, so that would be your golf club, your ski club, any other type of recreational club, are not deductible. So like we were talking before, they're specifically prohibited in the Act from being a deductible expense. However, that doesn't mean that it's not a business expense. So especially if you're incorporated and there is a business reason for that club membership, you should talk to your advisor. It can be paid by your corporation under pre-tax dollars. Remember that the club fees and the facility does not include the dining room. So if you are a member of a recreational club, the cost of entertaining for business, so clients and other reasons for business purposes, is a legitimate deductible business expense. So that's where you need to make sure you keep your invoices and your statements from your recreational clubs that itemize the expenses, and make sure you're identifying those dining fees that are done related to your business activities. And those can be deducted similar to meals and entertainment at other locations at a 50% rate. Again, note that a corporation can pay your club fees for if it can be described as needed for business activities or a benefit to your business. And the benefit of that is it's paid by pre-tax dollars. You don't need to pay that out of your after-tax personal income. The other thing that a lot of people attend are conventions. So convention expenses are deductible for business purposes. You need to remember that you're allowed 2 conventions per year, so a maximum of 2. If you do more than that, you can't deduct more than 2. The question a lot of people ask is, can I go to Hawaii? Can I go overseas for a convention? The conditional answer is yes, you can. The convention must be business related, and it's got to be located where the sponsor usually carries on business. So if that sponsor is providing the convention in that location, it relates to your business, you can deduct it. Couple things to keep in mind. If it's an all-inclusive convention, you do have to allocate a portion for meals and entertainment. So if it's a 5-day convention and you're paying one fee and it includes your meals, you need to make sure that your accountant knows that so that they deduct and allocate a portion of that to meals. Those again get to be deducted at the 50% rate, but they do need to be separated out. The other thing that we've come across with conventions is if you extend the trip to include a personal component, you can deduct the cost of transportation, so the flight there, but you should make sure that you're keeping track of the time at the convention and then the time personally and splitting those between personal and business related. Yes.
So if I'm at a convention and my convention is in Barrie, let's say, and so I have meals there, or
Yes.
Nashville or Hawaii.
Yes.
Barrie. Yeah, and we're in Barrie. I can only deduct 50% for meals?
Yes. So you're allowed to expense 100%. If you're doing it in your corporation, 100%. For tax purposes, the meals while you're away are only 50% deduction. So for tax purposes, you only get 50% of the value. So that's one of the provisions where they assume there's always a personal component to a meal. So rather than have you justify how much is personal, how much is business, what they use a general rate of 50%. We'll jump down because related to that, meals and entertainment. So that's where when you entertain for business purposes, it is a 50% deduction. And that's as well for the HST component. So if you're doing your HST, if you're a registrant and you're claiming ITCs, the meals and entertainment, you're only allowed 50% of the HST as well. So it follows the tax deduction of the expense. There are some exceptions, especially at this time of year is a good time. If you are entertaining your employees, and it's for a specific purpose and all employees are invited to the function, that event can be deducted at 100%. So when if you have an office party, you need to keep track of that entertainment expense separately and make sure your accountant knows that that expense was for a staff luncheon, a staff Christmas party, a summer barbecue, and those expenses can be 100%. So you can do up to 6 events a year when you're involving all your employees for various things. So keep that in mind when you're just accumulating all of your meals and entertainment. Don't slot in those staff functions in with your meals and entertainment folder because your account might accidentally only deduct 50%, and those you can deduct the full cost of those. Interest and borrowing charges. So remember, if you are using a line of credit or even a personal line of credit, that those are deductible expenses if they're used to manage your cash flow or that type of thing. You can deduct the interest costs. Be careful not to use your line of credit to mix personal and business, because then it gets muddled and it becomes difficult to decide what is business and what is personal. And CRA a lot of times will ask to see the line of credit statements and see the activities. So even though you may be overall borrowing for business purposes, if you're mixing personal activities in there, it can cause problems with deducting that. So if you are using a line of credit to cash flow some of your business, you should have a business line of credit and a personal line of credit to keep those separate. Automobile expenses, another favorite one. Everyone wants to write off as much as they can off their automobile. You can, again, if you use your car for business, you can deduct the business portion of your automobile. This is always something that CRA likes to look at, because they know the requirements are you must track your business usage, so which means you need to maintain a log of where you're driving, what you're driving for, the kilometers. Most people, it's difficult to maintain that, so it's a common thing for CRA to look at and say, okay, show us how you came up with your business usage. So as much as you can, you should keep a track of your travel activities, so that in the event that you need to provide support to CRA for why you're deducting automobile expenses, you've got a justification. So the way it works is you would take your business kilometers, you'd look at your total kilometers for the year, that percentage. So say you drive 10,000 kilometers in the year. If you drive 8,000 kilometers for business purposes, that's an 80% business use, and you would deduct proportionately your expenses. Again, because you're deducting the expenses, you have to maintain all your receipts, so your gas receipts, repair and maintenance, car washes, your insurance. So there is a lot of record keeping with this to keep track. CRA generally does not like just Visa statements, so I know it's easy to keep the Visa statements. It shows the purchases at the gas stations, and that they do want to see their actual receipts. We'll get into it a little bit later, but if you are incorporated or you're working through a business, we almost always recommend doing a mileage allowance rather than having to track all of your expenses and get reimbursements and that type of thing. So if you have the possibility of charging kilometer mileage to your business, it's a much easier way to go, and a much cleaner way. You don't have to keep all the receipts. You do have to maintain a log to justify the kilometers that you're getting reimbursed, but you don't have to keep all of the receipts.
Mike,
Yes.
with things like new tires or a new battery, would that be part of the 80-20 split? Or?
Yes, 100%. So new tires, new battery, any major repairs that you're doing, anything related to that vehicle would be an automobile expense. So if you're putting in a $5,000 entertainment or audio system, that may be a discussion that we would have with you as far as the need for that in the car. But definitely those major repairs to maintain the car definitely are deductible. The other thing that you want to keep in mind is the purchases of equipment. So major purchases of property, so things like computers, office furniture, or other equipment that you use in your business, those generally do not get written off in the year that you purchase them. They're treated as a capital asset for tax purposes, so they get written off over a number of years because they're considered that the benefit of those will be longer than 1 year in time. So you want to make sure you're thinking about, do I purchase things like cell phones, my laptop that I use at home? If you're buying things like that outside of your business, but you're using it for business purposes, you want to make sure you're capturing those. So those are some of the major things that we want you to think about and make sure that you're not missing when you're compiling your information for the year end.
Have you got to prove that a cell phone or a laptop is business related, or is that?
Generally, no. They would. Most businesses would require a cell phone, a computer to keep record keeping, communicate with clients, with employees. So generally, no. When you're reimbursing employees for, say, their cell phone costs every month, they'll generally allow the cell phone cost as a business expense for the company, as long as it's a reasonable or a basic plan. If you're providing your employees a complete full bells and whistles, they've got 2 cell phones, so their partner gets a cell phone, it covers all their data, so they don't need an internet at home, they're using their data plan through there. They may look at that and say, that's not reasonable, you're giving a personal benefit. But if you're providing a cell phone to your employees, so this is a little bit on the other side, but if as an employee benefit, as long as it's required for business, they have to communicate with employees or with clients, and it's not an excessive plan, then it will be deductible for sure. So one of the things, we're about 1 month away from the end of the year. One thing you want to think about is expenses are deductible as incurred. So the cash payment is not required in the year in order to deduct the expense. So it may be advantageous to incur expenses late in the fiscal year in order to reduce income for the year. So you can think about, if you're going to be making a purchase, should I be making that purchase before the end of the year? So if you're looking at a new laptop or something like that, is it time to replace that? If you do it before the end of the year, the asset or the expense has to be used in the year or available for use by the business. So if you buy it on December 30th but don't take delivery till January something, then you've got a problem. But if you do buy it towards the end of the year, and even if you don't pay for it, if you get it on your credit card, pay it in January, those still fall into your 2015 year. So you want to be thinking about what expenses did I incur for business, and make sure that you take advantage of all of those. So we talked about this a little bit with the cell phones and that, but we'll just touch on, because a lot of people here are either in business or have employees. So there are some tax efficient options to compensate and motivate your employees. The first thing we talked about was the automobile allowance. So this would include yourselves if you're the owners or shareholders of your company. Is you can do, as an employee benefit, reasonable automobile allowances. So instead of having to keep track of all your own automobile costs and take an expense on your personal tax return, the company can provide to employees a reasonable allowance. So what does that mean? That means it's got to be based on kilometers. So you can't give a flat allowance per month. So a lot of companies, just for ease, will say, okay, we'll give you $500 a month car allowance. If you do that, the employee or yourself is required to report that amount as income on your personal return, because the flat allowance is not reasonable. If you keep track of your mileage and report it to your employer, you can get a mileage reimbursement. So the important thing is to have a log. Key employees that have to drive in your business, you can reimburse them. It doesn't affect their personal tax return at all. The company is allowed to deduct it. The rates that you're allowed to deduct are at 55 cents per kilometer for the first 5,000 and 49 cents per kilometer above 5,000 kilometers. So it's a good allowance. Most employees would rather get that than have to get a flat allowance, claim the income, and then have to keep track of all their expenses. Employee gifts, so we'll talk a little bit about that, is you can provide gifts and awards to your employees. So this is something where I said the automobile allowances and a lot of the conventions and things like that, the shareholder, owner, manager can take advantage of. This is one thing that you can't do if you're the owner, but you can do it for your employees. So you don't want to do it to any related family members that are part of the business, but you can give gifts, and there's an administrative policy with CRA that gifts up to a maximum of $500 can be given, deducted by the company, and not taxable to the employee. So this is, again, kind of coming into this time of year, you're coming into Christmas. It is a nice way to motivate your employees, to thank them for work they've done. The couple of rules that CRA, silly rules that they have, is no cash. So if you give them $500 cash, it is taxable to them, so it's just like giving them their payroll. So they'll want you to include it on their T4 slip. So it must be for a special occasion, so it can be on their birthdays, it can be at a holiday, so as Christmas is coming up. If they are getting married, if a employee's getting married or something like that, or has a child or something like that, you can give a gift to them and deduct it by the company. Again, up to $500. It has to be non-cash, no gift cards either. So cash or near cash is the rule. So if you give them a gift card, CRA, and the receipt shows it's just a gift card to Best Buy, CRA will consider that cash and say you should have charged the employee on their T4 slip. They should have paid income tax on that, and as well as withholdings and all of that stuff. So if you want to do it, go somewhere where there's good refund policies, buy something nice, they can take it back and get whatever they want. So, but then you've got the receipt that they've, and so that's...
So as long as it's not like, you can't put it, like, just give them $500 and it doesn't show up on their T4.
Yes.
You can give them like a really nice coat and
Yep.
say you can keep the coat or take it back.
Yeah, you do, yeah,
And it's
you
worth
do.
$500.
Exactly. So you kind of...
It's deductible by the
Yes.
company and
So
tax-free?
yes, yes. So you got to jump through a little bit of hoops with the rules of CRA, but you can get to the end result of what you want. You want to get them the option of going and picking their own
It's an
thing.
interesting meeting, but I think it's a great idea. You're all getting a coat and a watch.
With a gift card.
Yes.
I'll give you the bill.
Sorry.
Even for the birthday gift.
Yep.
I have to buy physical stuff.
Yes, yeah, it can't be cash.
Okay.
Yep.
But at the end, you have one line says only once every 5 years. So if I give a birthday gift, that means every time I only can give $100. It's 5 years, it adds up to 500.
Yeah, sorry, that you can give a long service award once every 5 years. So on their, but you can also give an annual gift for a holiday. So you can double up once every 5 years and do that. So definitely, and not taxable to the employee. So it's definitely,
Deductible by the business.
yep. So you'll see a lot of companies do 5-year, 10-year awards. That's kind of why they're doing it. It motivates key employees and gives an opportunity to recognize people that stay with your organization, and to give them something, and the company at least gets the deduction. It doesn't impact the employee, so it's usually well received by your employees. So.
Yeah, that's what I'm
Yeah.
saying. Like,
Yeah.
you can give them a coat and
Yeah.
you go to Best Buy and give them a TV and they're going, I don't want one.
Yes.
Receipt.
Yeah, yeah, sure.
For this 500, they're saying you cannot buy
S-
check.
Yes, still it's got to be, yeah. Anytime you give cash, then it's going to be considered a taxable benefit to
And
the.
no EI or CPP or.
No EI or CPP as long as you're buying them a physical good. So a couple things you can do. The other thing is employment-related training. So as long as there's value to your company, there can be definitely a benefit to the employee that they're getting training, they're developing their skills. But if it's related to your business, you can pay for those. Again, it's not taxable to the employees, it's deductible to the company. So again, for key employees, it's a good way to keep them with your organization. You're developing their skills, they're improving their skills for you, but they don't have to incur any costs. So you can definitely pay for those.
So Mike, I can send somebody to say California, maybe Pebble Beach or something like that, and for some good reason.
For some good reason, it'd have to be for a good reason. It'd have to be for a specific course or training that isn't available here and is provided there. So, so there has to be some reason. There's a little bit of catch. Jerry and I will talk to you later. Yes, not golf training. Yeah. So. Yep. Yep. Yeah. So and it can be quite general. Like it could be things such as time management, stress management course that they want to take. Can be first aid, employment equity, things that just general topic stuff that does help your business. Things that are purely personal interest training you want to stay away from, but definitely it's another nice benefit to key employees to keep them happy and interested. So now some things that you can think about before January 1, 2016 related to your investments that you have and some things that you can do to minimize your tax or at least defer some tax. So the one thing, we'll get into this a little bit more when I get to the next section, which is the new changes coming. But you may want to talk with your advisor about consider moving planned dividend distributions from 2016 into 2015. So depending on your situation, your cash flow situation, if you are planning on a significant distribution out of your company to yourself or to family members, depending on where your tax level is going to be, there could be a benefit to doing it this year rather than waiting next year. You will prepay some tax because it'll hit your 2015 personal tax year, but the personal rates, especially at the high level of income, are increasing, and there's going to be, from what the plan is, an expected 5% increase in the tax on dividends at the high rate starting in 2016. So if you do some cash flow analysis, depending on when you need the cash, you could save that 5% tax. You'd have to prepay your tax in 2015, but by saving that 5%, if you have the money available, you're probably better off doing that now. So definitely something to consider.
I'm sorry if I dominate on that
Yes.
sort of thing, but you said it's a 5% difference on distributions, on dividend distributions this year than next year if you're at the
Yes.
top margin.
Yep.
So that's pretty significant.
Very significant.
So
Yeah.
people should really take a lot of dividends out this year if they're going to take them.
Potentially,
They're already
yes.
at the top
Well,
margin.
and that's where,
Top margin.
yeah, if you're going to be at the,
5%.
yes, if you're going to be at the top rate and the funds are available to pay the tax in April of 2016, there's definitely an advantage to considering that and taking that dividend December 31, 2015, prepay the tax, but you're saving that 5% permanent. So definitely something. It's an after-tax return, yeah. So really, the cost, the benefit, there's a good benefit to doing that. So if you're going to be in the high rate, both sides, definitely something that you want to consider.
What is the high rate?
The high rates for 2016 for dividends is planned to be for eligible dividends, it's going to be 39.34%. So this year, 2015, it's 33.8. So that's a 5.5% for eligible, an increase at the high rate. So once your income is over about 217,000. Non-eligible dividends are going to go to 45.3% from 40.1. So again, that just over 5% increase.
And for most professional clubs and so on, we're usually talking about regular dividends, not
Usually you're talking about the non-eligible dividends. So you're talking about paying 45.3% going forward instead of paying 40.13. Even your salaries, so your basic, your regular employment income, the high rate is, right now it's 49.5. It's going to be going to 53.5. So it's going to be a 4% increase on just regular income. So it's right across the board, everything's going up. So that's really the time to consider maybe we move some income into 2015. Yes, we're going to have to pay tax sooner, but you're saving that. It's a permanent tax savings.
My last question on this.
Yep.
When you talk about the planned dividend distributions, for those that don't have professional corporations, they may have a holding company.
Yep.
And I read something recently where they were talking about Revenue Canada's, did they say something about that if you pass an intercorporate dividend, it's no longer tax-free, it could be deemed to be a capital gain?
It can be, yeah. So, and a lot of the professional corporations generally don't have a holding company, but most of our operating or other businesses will have a holding company where you move your surplus profits from your active business for creditor proofing and just to keep the surplus assets separate from your operating business. There is the risk of intercorporate dividends being considered a capital gain and not a intercorporate dividend, which is generally non-taxable. So
Can you explain it, because it's a big thing
Yep.
for people that do that a lot. It has something to do with safe income, and
It-
I don't get
yeah.
safe income.
Yeah, so I won't go into the intricacies of it, but essentially safe income is tax paid income. So generally it's your retained earnings. So when your operating business, it runs its year, it makes $100,000 of income, pays $15,000 of tax, there's $85,000 left in the net income after tax, that flows down into your retained earnings of the operating business. Generally, that $85,000 would be tax paid retained earnings because you've paid tax on the 100, have the 85 left. That would be considered safe income, and then that can be paid out from your operating company, as long as the holding company owns at least 10% of the shares. It can be paid as an intercorporate dividend, no tax until it comes out of the holding company. The problem is over the years, as you do transactions and things, there will be a lot of times where there's things that affect your retained earnings but don't incur income tax currently. So you may have a transaction where you have a gain, but you haven't paid tax on it yet. So there is value in the operating company, and there's definitely a reason to pay that dividend out. So you could have portfolio investments or other investments where there's an embedded gain in the operating company. You want to strip that out to the holding company. You could generate a retained deficit in your operating company by paying the dividend out, but you know you've got assets. So in that case, they would look at that and say, well, you're really transferring the unrealized gain or gain that you haven't paid tax on in the operating company. We're going to tax you that's going to be taxed in that company as a capital gain. The other thing is where you have non-deductible expenses. So things like club dues go through your company. Those are non-deductible expenses, so you haven't paid tax on those, and it goes through the retained earnings. So you do need to do a safe income calculation, especially companies that have been around for a number of years. The capital gain tax, at certain times, it's not a bad thing. And it's, again, something that your advisor would talk to you about. But there is at times the opportunity to, where it makes sense to do that dividend because there has been accrued gains or value in the operating company, pay that intercorporate dividend, generate the capital gain tax because you're going to be paying out a dividend anyway to the individual. So it flows up, the capital gain. That generates what's called a capital dividend account in the holding company. So that generates, so if it was, you did a $100,000 dividend and for whatever reason it was treated as a capital gain, 50,000 of that would go into a capital dividend account in your holding company that can be paid out to individuals tax-free. So depending on the situation, it may make sense to generate a dividend that creates a capital gain that is going to be paid out and be able to be paid out tax-free. So it's not always a bad thing. Most of the time it won't affect most of the intercorporate dividends, but it is something that the accounts are looking at because of the rule change. They've said they're going to look at it because they're not meant to just catch most of the regular intercorporate dividends and planning that businesses do, but when you read the wording of the legislation, it does sound like it will catch a lot of instances. So when you're looking at intercorporate dividends this year and coming years, a lot of times your account will look at that and say, do a calculation to say, are you at risk of a deemed capital gain? So there is a risk, but it's your non-tax paid retained earnings that is at risk. Okay. A couple other things that you can do. Consider tax loss selling before the end of the year. So you should look at your investment portfolio with your advisor, with your broker, and consider if you've incurred some significant capital gains in the year or in the previous year, and you do have some investments that are at a loss and don't make any sense to hold anymore. Consider selling it before the end of the year. That'll realize the capital loss and allow you to either use it against gains that you've already realized this year or carry them back to up to the last 3 years.
Like, wouldn't it make sense, though, if you're expecting to have future gains, that you just keep the losses available, use them next year when the tax rates are higher?
Yes, and that's the other thing too. So again, you'd want to look at, you might want to trigger the capital loss because you don't want the investment anymore and decide, well, I'm not going to carry it back. I'm going to leave it there because I know next year or the year after I'm going to generate a significant capital gain. So again, it's something that you want to consider and talk with your advisor about, because it could make sense to do it this year and take advantage of it. It may make sense to do it and carry it forward for the next year because the capital gain rate, just like everything else, so your regular income rate is going up 4%. So your capital gain is half of that, so it's going up 2%. So pretty much everything is going up. So that, again, is something to consider. The one thing to think about is you got to sell it before December 31st. There's the trade date and the settlement date. So generally you want to do it by December 24th if you are going to make a transaction because of the stat holidays, weekends, and that. If you wait to the 28th or 29th, by the time it settles, it may happen January 2nd or January 3rd, which would avoid being able to use it in 2015. So if you are going to do that, you want to look at it over the next couple weeks and make a decision before Christmas to make that transaction. Maximize your TFSA contribution. So related to the Liberals, I'm sure you heard in the election promise that one of the things Trudeau found particularly offensive was that the Conservatives raised the TFSA limit to $10,000 this year for 2015. So he made a campaign promise that he's going to roll that back to $5,500. That is not going to happen for 2015. So the legislation for 15 is $10,000. So you can do that contribution. So if you haven't done it yet, you can do that. For 2015, the cumulative amount that you could have contributed up till now is $41,000. So you want to look at your portfolio. If you've got non-registered investments, you want to take advantage of the TFSA contribution room. There's uncertainty what's going to happen in January 1, 2016. It was a campaign pledge of Trudeau to scale that back. So the legislature, Parliament's sitting December 3rd. So that first week of December, probably December 4th, there's probably going to be some policy announcement from the Liberals saying what they're going to do. They'll probably indicate what they're going to do with this TFSA for January 1. So it's not sure if they'll be able to get all their ducks in a row to get the legislation, everything passed for January 1. You talk to some brokers, they're saying they're watching this, and on the January 1, if the legislation isn't in, they're throwing in the $10,000 into the TFSA. Others are saying they're going to wait and see what happens and then do the $5,500 on January 1 and then wait and see what comes down. So it depends on, you may want to discuss that with your investment advisor and with your accountant. We're not sure how they're going to go about dealing with that, but in all likelihood, we'll know in the first part of December that it is going through that way, that it will scale back. But
can they do it retroactively if they don't get their act together by January 1?
yeah, they can. So they would do it back to January 1. So if they announce that the intention is we're introducing legislation, it'll be effective January 1, even if that hasn't received royal assent, I would go with that intention. From what we understand, they won't go back to January 1, 2015 because most people have already made that contribution.
But let's say they've got so many things on their plate and they don't get it done by December 31st of 2015. Like, what's to stop us from putting $10,000 in on January 2nd?
Yeah.
If they implement legislation in March, they can't go back because the legislation was already passed on January 2nd and you've got 10,000.
Yeah.
Can't you just do that?
The current legislation is $10,000, so you're following the law, the current law that allows the $10,000. They'd have to provide some sort of mechanism, I think, if they'd want to scale it back, that you have a period of time to take that back out if they're going to retroactive it to January 1. For all intents and purposes, I think they'll give an indication because they know this is a hot button issue for a lot of people because they do provide, and a lot of people use this as a family income splitting tool. So the criteria for your TFSA contribution is Canadian resident over the age of 18. So if you have family members, you might have elderly parents, you may have adult children that have that room and don't have the resources, you can give them the money to invest in a TFSA, so you can multiply that. So a lot of families will do that. So they know that it impacts more than just the 1% earners. There's a lot of other family members that are benefiting from the TFSA rules. So they know that this is something that everyone's watching and waiting for.
Doesn't this get a lot more complicated though? The only place you've got your money is in a corporation. You've got to give yourself a dividend to put it into a TFSA and decide on which is better.
Yeah.
Corporation.
Yes.
So with the 5% differential, it makes some sense.
To do it before.
Yeah, do it before.
Mm-hmm. Yeah.
Unless you've got some kids coming along, they're going to be save it for them.
Yeah, 100%. Yeah, 100%. The other thing, so take advantage of family income splitting. So the other thing, right now, the prescribed interest rate is 1% for that can be used. So if you're sitting on a significant portfolio, you're in the high income bracket, you can lend money to a family member, so to your spouse if she's at a lower income, to your children at a lower income at 1%, and they can take that money and invest it and then the investment income, rather than you getting the interest and dividends and being taxed at the highest rate, you can split that so that your family member is incurring the dividends and interest income, capital gains at their marginal rates. So again, it's something to consider. They would have to pay you the interest, so it's not like where you might loan them to buy their first house, where you give them the loan, it's documented, there's no interest, no payments. You want the interest paid annually on the 1%, but the margin on that is quite good, because if you're paying at the high rate, your adult children or elderly parents or your spouse might not have the same income level, so you can split that investment income. Obviously, it depends on the family situation and how you get along with your kids and your spouse, but it is an option. They change the prescribed rates quarterly, so right now it is 1%. So you could do a promissory note, and that 1% stays there forever. The other thing that you want to consider is, if you are making charitable donations, gifting publicly traded securities. So what that means is, if you've got non-registered investments, they've accrued some gains, and you're looking at and saying, well, I'm gonna donate this year to the hospital, say $25,000 or $10,000. If you donate per your cash, so say you have to sell your shares that have an embedded gain, you're going to pay the capital gain tax, and then you're only going to have the net amount. So just for round numbers, say you have an investment with worth $100,000 that you bought for $10,000, and you want to make a gift. So you've got a $90,000 gain. So if you were to sell that investment, you'd have $90,000 gain. You'd pay 45 on tax on $45,000 as the 50% taxable. You'd pay at the high rate $22,000. There'd be $77,000 left to donate to your charity. The alternative is you directly give them the securities. So you would give them the $100,000. The taxable gain to you is deemed to be zero because you gifted the shares, and you get a tax receipt, charitable tax receipt for $100,000. So it's really a good benefit that is provided. So if you are considering giving a significant contribution or donation to a charity, you want to look at your investment portfolio and see if this is something that you can take advantage of. One thing that they are bringing in for donations is starting January 1, 2017 is, so some people have invested and built up large portfolios and have this possibility of gifting marketable securities. There's other people that have always shied away from investments, so they may have built up their business, invested their money in developing and building their business, or they may have invested in real estate. They don't have publicly traded securities. So they're talking about bringing in a new rule that you can donate those assets or the proceeds from those assets and take advantage of getting a zero taxable gain, similar to donated publicly traded securities. So that would be, if you were selling a piece of real estate or a piece of property, the gain on it, if you donated that gain, those proceeds to a charity, you would, again, the taxable gain would be deemed to be zero, and you'd get the full donation receipt. So a couple things to think about is the difference between the publicly traded securities and real estate or shares in your company is you have to sell them, whereas this, you give the securities directly to the charity. The new legislation is you sell your real estate, realize the proceeds, and then within 30 days you have to gift those to a charity. And then
Higher proceeds that you have to do?
No, so that's where there could be some planning. So it can be prorated. So one thing that could be done is, say your grandparent has got a cottage and is looking at selling that cottage. You may want to look at deferring that sale till January 1, 2017. So this is anything after 2016. So they sell the cottage, realize a gain, proceeds of $500,000. Maybe the gain is $250,000. They can donate anything up to that $500,000 as long as it's donated within 30 days of the sale of the cottage. They'll get to exempt the prorated amount of that sale. So say they give $50,000 of the $500,000, they get 10% of the gain exempt at zero, and then they get a full donation receipt deduction. So if you're thinking about selling real estate, it may be an opportune time to do some gifting if that's part of your ultimate plan, the timing of that. So it has to be done within 30 days. The couple things, January 1, 2017, cannot be sold to a related party. So you can't sell the cottage from your grandmother to yourself or to a child. So they want it to be a legitimate sale transaction to justify the fair market value. So if the intention is to keep it within the family, then this doesn't work. But if you are selling a property, you can take advantage of this opportunity, and the tax savings could be significant. The only last thing, which I'm sure all of you are aware, is just make sure you've maximized your RSP contribution before the end of February 2016. So you've got the 2-month grace period to make sure your max is in. If you are turning 71 this year, you got to remember the RSP contribution has to be done in the calendar year. You don't get the 2-month exemption. Again, with the changing tax policies, you want to talk with your tax accountant when they're doing your tax return and looking and seeing, does it make sense, depending on your income expectation for 2016, to definitely make the contribution so the money's working, but save that deduction and deduct it in 2016. So there's going to be a lot of discussion about when do you take advantage of your deductions. Is the time value of money worth it to wait and get a bigger bang for your buck? So you can carry forward your RSP contribution. You don't have to deduct it in the year that you make it, so you can carry it forward and that's just a common thing to think about anytime you're making contributions or talking with your kids. They may make a significant contribution to their RSP because they have the availability, but if they're in a lower middle tax bracket but have available cash, they may want to carry that forward if they know in the near future, within a year or two, that their income's going to go up to the higher levels. It may make more sense to wait and take advantage of the deduction at the high rate. So now we'll talk just about making sure you're getting the most out of your corporation. So the ones where you are a business owner, you want to think about, are you compensating your family members for their work? So you can definitely, most of you probably are paying your family members' income, but if you're not, you should think about it. You can pay employment income to family members that provide legitimate services to your business. So even younger family members, if they're coming in and helping, doing some filing, doing some reorganizing in the office, cleaning your office every so often, those are legitimate services, and you can pay them for that and get funds out, get the deduction in the company, benefit the family members, utilize their lower tax rates. Have you thought about loans from your corporation? So there are times when you can loan from your company to yourself for employment purposes. So what you can do, and again, the prescribed interest rates are at 1%, so you can loan to yourself at the prescribed interest rate. So if personally cash flow is an issue, the company has available funds. For employment purposes, the one thing we generally always tell our clients is not to have their personal vehicles in the company, own the vehicles personally. If you're required to drive for work and you need to buy a car but you don't have the cash available, you can consider the company loaning you a loan to purchase your car at 1% rather than going to the dealer or to your bank at 4 or 5%. A couple things that you got to be careful of is the shareholder benefit. CRA would generally look at it and say, you're giving that money because you're a shareholder. You want to make sure that you have an employment contract. So almost all of you that have a business, you should have an employment contract that says you are an employee of your company and lists the responsibilities and requirements, which include traveling for business purposes. So if you have that, you can justify an automobile loan. You'd have to set it up to terms similar to what you can get outside of your corporation. So you see on the news, car loans now can go up to 96 months. So you could do a 7 or 8 year loan at 1% to pay for your automobile. You would have to repay, set up an amortization schedule, make the payments on the car loan. But if you're going to be making those car payments, loan payments personally anyway, this is a cheap way of funding that. Where we've done it occasionally is if you're planning on, you have your corporation set up and you're planning on moving, say, your practice from London to Toronto. So you're moving for business purposes, you're an employee of your professional corporation. You can consider doing an employment loan, home buyer's loan to purchase your new property, your new home. To move to where your business is. And again, setting it up, say a 5-year term, amortized over 25 years, but at that 1%. So in certain circumstances, there is an opportunity to loan funds out at a cheaper rate than at market rates. The other thing is fluctuations in your corporate income. So if your income fluctuates from year to year, you can take advantage of the income tax rules and minimize tax costs and installment requirements. For your corporate income, expenses are deductible when incurred rather than when paid. So you could consider accruing a bonus at the end of your year. So if this is a high year, you'd want to consider, well, let's accrue a bonus this year, pay it out in the low year. And so you're basically paying out your same employment income or same draw, but you're getting the deduction in the high year, subsidizing the low year. And that bonus can be paid out up to 179 days after the year end and still be a legitimate deduction in the current year. And the last thing is just the transfer of non-personal assets to your corporation. So that's, again, with this rising income tax rate environment, in certain circumstances, it may make sense to, if you have a non-registered investment portfolio, you're generating significant personal income. In certain circumstances, it may make sense to transfer those assets into your corporation. Or you have other non-personal real estate that isn't your principal residence, transferring that in, creating a shareholder loan. So instead of taking out dividends at the high rate, you could repay that shareholder loan to you. So there is a process to transferring personal assets into your company on a tax-free basis and generating these shareholder credits. But you'd want to talk with your accountant about doing that. But that's definitely something to consider, especially if you're at the high rate and you've got surplus assets outside of your corporation.
Does that work for whole life insurance policies too?
Yes, yes. So Terry would know better than me. It's January 1/17, is that right, with the
They're okay with that still, but every year I keep thinking that the budget, the budget is going to change the ability to transfer personal life insurance policies into corporations, and they continue to astound me that they haven't changed that, because it truly is that fictitious word loophole in the Tax Act, right?
Yes, and it seems like one of those things when they talk in code, he's talking about loopholes and advantages to the one percenters. This is one thing that they always look at that they don't like.
I was at a Revenue
So,
Canada
yeah.
meeting, and they called it an unintended consequence
Yes.
of the Income Tax Act. Well, it's a loophole.
So
Under-
Terry, would you be recommending them do that sooner rather
As
than
soon
later?
as I
Soon
know
as-
that you've got
Evaluate.
a personal policy, it's going into that
Yeah.
corporation unless there's a good reason to stay out. I would encourage anybody that's got personal life insurance policies to really talk to
Mhm.
their advisor about moving that
Yeah.
and do it before the next budget.
Yeah, yeah. And that definitely generates can generate a significant shareholder credit that you can take out of the company tax-free. So instead of having to take out dividends, if you do have a personal policy, it can be a mechanism to be able to take those surplus funds out of the corporation and not get impacted by these high tax rates that are coming up.
It's such a good deal every
Yeah.
time you tell somebody
Yeah.
that, they go, it's the
They don't
too good to
believe
be
it.
true
Yeah.
rule, and so
But-
therefore I know it can't be real.
And
it's
it-
real.
and it is real.
It is too
Yep.
good to be true.
So,
Do
yeah.
it.
Yeah. So definitely something to consider, but definitely if you do have insurance policies that are not in your corporation, you should be talking to us, talking to Terry, talking to somebody about that. So now what I'm sure a lot of you are wondering about is what does this Liberal government mean to everybody? So not just the new marijuana laws, they're going to be doing a lot of things to do with tax policy. Yes. So yeah. So there's a lot of talk in the election about going after the one percenters, going after tax loopholes, changing the rules so that the preferential rates for small business are used by people with small business and not used by high income earners to shelter income. So definitely some changes in tax policy that are going to be troublesome for a lot of our clients, a lot of our incorporated clients. So we'll go through some of these for you to consider. So we talked about these briefly, but the combined top marginal rates. So what they're looking at is the high rate above taxable income above $200,000. With the personal tax credits you get and stuff, you won't hit these until about $215,000 to $220,000 of income. But from what they've indicated, your regular income's going up 4% at the high rate. Your capital gains are going up 2%. Eligible dividends are going up 5.5%. Non-eligible are going up just over 5%. These are the combined rates in Ontario. If you go across the country, some of them are much worse and some of them aren't as bad. If you go to Alberta, which everyone used to be flocking to, the rates are drastically changing in Alberta and becoming much more expensive. So this is the environment that we're dealing with. So again, what we want to consider is what does this mean? So you really want to get into with your advisor and talk about planning your income as much as possible. What can we move forward to 2016? Make sure we're taking advantage of all those income splitting opportunities with our family members to minimize these high costs as much as possible. One thing not related to these tax changes is moving to another province. So for those of you, or if you have children or other family members that are looking at moving before the end of the year, generally you pay your combined rate of tax is based on where you're resident at the end of the year. So again, that's something to consider if someone's looking at moving towards the end of this year versus the first part of the new year. If you can get that move in, you'd want to look at what the marginal rates are for 2015, and you may want to accelerate that move before the end of the year, or wait till the end of the year, after the year. The one thing the Liberals have indicated that they're not going to do is stop the reduction in the small business rate. So the Conservative government put in legislation that the small business rate will drop by 2% over the next 4 years, so 0.5% a year. So right now in Ontario, your first $500,000 of income for 2015 is 15.5%. That's going to drop 0.5% a year for the next 4 years. So 2016, your corporate rate's going to be 15. 2017 will be 14.5, and all the way to 2019 will be 13.5. The one caveat that they're talking about is they did provide commentary that they intend to ensure that Canadian-controlled private corporation status is not used to reduce personal income tax obligations for high-income earners rather than supporting small businesses. So they haven't said what they mean by that. We're concerned, we think we know what they mean by that. They're looking at owner-managed businesses that have no employees. So they're looking at your professional corporations that generate significant income. And some in the Liberal Party find that offensive, that professionals now can incorporate and take advantage of these small business rates, and they don't think that's right. So we'll see what comes out December 4th, but we're concerned that is the trend. The Quebec government put in legislation for to take advantage of the small business rate. A CCPC had to have 3 full-time employees. So you can think of how that would impact a lot of your professional corporations or smaller businesses that are really just the husband and the spouse that are employees. So
Is that 3 total employees or 3 arms length?
3 total. So, but it had to be full-time employment. So I don't know if they would count your spouse as a full-time employee, even if you're paying her or him a wage. I don't know.
So potentially, they could take away the small business credit. So instead of 15.5%, what would that be, a tax rate of 27? Is that what it is?
Yeah, it'd be the 26.5%. So we don't think that they would apply the personal service business restriction because you're not an employee of a specific, they couldn't consider you an employee of a specific employer, but you'd be at the 26.5% rate. So then in that instance, then the planning would completely change to, okay, how much do we leave in the company versus paying out wages rather than dividends?
But if they did it and I think this is a really big point, because I must get a call a day now about, well, I hear that we're not going to be able to have a professional corporation, which is not the truth. You can actually continue to have, if they go that route,
Yep.
a professional corporation, which your tax rate will be higher. Instead of 15.5, it would be 26.5 if we look at this year.
Yeah.
But then wouldn't your dividends paid out be
Your
eligible?
dividends would become, that's correct. So your dividends would become eligible dividends at the less tax rate. So your blended rate would be 39.34 plus 26.5, right? So you start looking at that. Once you get over that high rate, you're starting to get to
That's
64, 65%.
To the whole ability of having it at the end of the day, just that you kept whole compared to somebody that didn't have a corporation.
What it does get is the dividends to the kids. Because you're paying
Yes.
7% more in the corporation, you're not going to be paying your taxable dividends to the kids, not paying the
And
tax.
if it's a whole, so you get your RDTOH.
Right, but if it's a professional corporation, you're splitting
Yeah.
incomes.
Yeah, so there's-
Effectively 7 or 8% higher. dividend.
Like, that's massive.
Yes, so there's still a benefit to, to income splitting, so you're still eligible to have family member shareholders that you can split out the income. So the older professional corporations that have adult children can take advantage of that. The ones that have younger can't. They can do it with his or her spouse. And then the money that they don't need personally, they're only paying at 26.5%. They can still accumulate surplus in the corporation rather than taking it out and paying at the high rate. So there's the deferral advantage. It's not as good as the small business rate, but if that comes to pass, that it won't be as good a deal as it has been in the past.
Well, it's ridiculous, deal.
Yes.
Because you're at 20, let's make it 27 plus 39.
Yeah.
Like that's 66. How does that make any sense? Where am I missing this?
No, it's-
No, it's.
Well, you have to consider it, if you have $100,000, take off 26.5, you're left with 73.5.
Yeah.
Then you,
pay
then you,
39.
yeah,
All right.
yeah. So it combines gets you down to just over that. And
It should work out to be 52.5.
there's, the integration is close. It's within less than 2% versus having it all come out as a salary direct. But yeah, so you'll be about, if you did it in the corporation, then paid out a dividend, you'd be a slight disadvantage compared to paying it all out as a salary.
What about regular corporations, non-professional corporations that don't have any employees?
Our understanding in Quebec is that there's an issue with them that
So
they.
do I. I've
Yeah,
heard that too.
yeah.
It's a
So
huge issue.
we're not sure if the idea is. Definitely, the Liberals are watching Quebec and seeing how this is going to play out, and then they may see, okay, this has generated significant revenue for the Quebec province. It hasn't hurt their economy. Let's roll that out. So it could be. It likely won't happen right away, but it's going to be something that the Liberals are going to be looking at over their 4-year term.
Yeah, well, I
Yeah.
hope they look at Ontario right now, because under the medical professional corporations, the clawbacks and everything else that are
Yeah,
happening is
well,
ridiculous,
yeah.
and it's a huge thing
Yeah.
for people to get over. You add that in there,
Yeah.
that's, you're gonna have everybody.
The challenge you have, though, is you have to consider about who they're targeting. If they target a physician or a dentist, the general population
Doesn't, yes, their constituency, that's right.
Until
And,
there's no more doctors,
no.
and we whip them to
yeah,
go back.
well, and it's funny because the whole environment of setting up the ability to have professional corporations and giving the special exemption to doctors and dentists to have family members as shareholders was so that they would stay and rather than give them compensation increases, they give you this flexibility. And now they seem to be swinging back the other way and saying, well, let's go after the people that have
Yeah, then that
perceived to
whole
be
idea-
doing better.
Yeah, and really a lot of the question is just to lead, like, there's not gonna be the end of the NPCs and the
No.
EPCs or anything else. They're sticking around, it's just gonna be taxed differently, it's gonna be taxed higher in the corporation, and when you take the dividends out, it's gonna be taxed lower than a normal dividend.
Yep.
So it should be basically a wash, but just planned differently. And really, I would think that offering those children that are age 18 and over, not only potentially dividends, but maybe, loans at prescribed rates.
Well,
might be a-
the loan from the company, you can't do the loans at the prescribed
If
rates.
they take it as income, you can.
Correct, if they take
If
it as,
income,
yep,
so anybody over the age of 18 or 18 and over could take a loan
Yep.
from the company.
And-
treat it as
and pay the
and
income
have
at the
no
lower rate.
income.
Yep.
And then when they pay it back, it's a tax deduction.
yep, at their higher, and we've done that at times with
I've
when,
done it twice.
yeah, when they're
Very
first,
effective.
yeah, because when they're first starting out, they may not have significant income, so you can get that significant funds out as a loan, and then repay it when they're generating income at the higher rate, and get the deduction.
These types of things are so important, and
Yeah.
this is why the accounting work is
Mhm.
really important. And the accountants that are in this room, I know all of you, and you actually do sit down with your clients every single year and say, okay, this is how you take your income, and this is why we're going to do it this way, and you
Yeah.
can do this, and you can do that. What I find is, I'll say to somebody, well, how are you taking your income? They'll go, oh, I'm doing dividends only, I've done it for the last 5 years. And I go, well, I think there's another way to do this, you know? Yeah, well, nobody's told me anything different. Well, you just leaving money on the table. Like,
Yeah.
there's so much you can do, and we don't need to fear so much if
No.
we're very
Yeah.
aggressive on making sure that we pay attention to this.
Yes, 100%. And yeah, it's worth having that discussion.
It's worth $1,000
Yeah.
an hour that we pay.
Yeah. And it's important, yeah, and it's,
You gave us a reduction.
yeah. Yeah, and it's important for us to know your family situation, know the family members, know what they're doing, how old they are, they're getting out of school, where they're going, because there's advantages still to be taken, so.
Right, and even
Yeah.
those people that don't have children, that this is applicable to anymore, there's some still awesome things you can do.
There's still the benefit and flexibility of the corporation. It may not be as lucrative, but there's still benefits that we
And
can
my
take
last
advantage
comment, then I'll be really
Yep.
quiet. I just want to remind everybody that the cash accumulation within a life insurance policy is totally tax sheltered. I'd be good at that.
Afraid you say that every time I've,
Yeah, I know. I might be like a broken record.
Do we know, Mike, if they're gonna make any announcements, do we have to wait for the budget to?
From what we've heard is, so Parliament reconvenes December 3rd. We're expecting that there'll be an announcement fairly shortly after that as far as what their policy plans are going to be. So put a lot of these thoughts that we think they're going to be doing, they'll start saying this is what we're going to be doing, and we're going to enact legislation. So the idea is we'll be watching that first week of December to see what the announcements are.
My concern is that they may just tell you what their ideas are, but they're not gonna be specific enough that you can really plan on.
It could be troublesome if they just give general things and say, we'll let you know in March when the budget comes out, but we'll wait to see. These are some of the other things that they've promised. Canada Child Benefit. So they were giving a tax credit, a tax benefit, a check to everyone who had a child under 18, regardless of income. Again, that was offensive to the Liberals because high-income earners were getting this check. They're going to change the UCCB, the Universal Child Credit, and implement this Canada Child Benefit. It's going to be very lucrative for low-income people, not so lucrative for higher-income people. Once you get to family income about 200 grand, you're not going to get any check at all around. But right now, kids over 6 get $60 a month, so $720 a year. Kids under 6 get $160 a month. Yeah, so they get even more. What they've said they're going to do is give for kids under 6, $6,400 a year. Kids up to from 7 to 18. $5,400 a year. So you can see that's quite a bit more, but it'll get ground down for income as your income. I think it's about 30,000. As it goes up, it'll grind down to when your family income is about 150 grand, you'll get the same as you did under the UCCB. So it'll work out to about $700 for a kid over 7 and $1,900 for a kid under 7, but those lower income people are gonna benefit quite a bit. Students, they're looking at eliminating the textbook and education tax credits. So when you go and take a course at a university or post-secondary, Currently, you get a credit by month for textbooks and all that, and then you also get a credit for your tuition. You'll still get your credit for your tuition, but they're going to get rid of the textbook and stuff and provide grants, again, to lower income people. If you're at a higher income, you lose that benefit. So you'll still get your tuition credit, but if you're a student but have significant income, they're gonna grind you down. So that's one of the other things. Employment insurance, they're gonna look at improving employment insurance. They're gonna keep with the conservative plan that reduces the employment insurance rate. So those of you that do have non-arm's length employees or arm's length employees that you pay employment insurance, that rate is coming down. But they're improving the benefits so that people don't have to wait as long or have to be employed as long to get employment insurance. Old age security, they're scaling back. The Conservatives were bumping the age to 67. They're going to bring it back to 65. And then they are going to provide some flexibility to the home buyers plan. So the home buyers plan currently, a lot of time you can use it once, first-time home buyers. They're going to provide some flexibility. So if you have a significant life change, so say you go through a separation or have marital breakdown accommodating an elderly family member, and you can access your RSPs to purchase a home. So those are some other election promises that are going to come through. One last thing I want to touch on is the change. Many of you may have heard the change to testamentary trusts. So these changes are coming in as of January 1, 2016. So these affect, so those of you that have elderly people that have passed away, their estate may have transferred into a trust rather than just being distributed to the beneficiaries. Currently, there was a significant benefit for families that had significant assets to leave the money in a trust, in a testamentary trust, so testamentary is a trust that gets set up on death. Because the trust currently was treated as a separate person under the Tax Act, which meant it got the graduated rates, income tax rates that an individual got. So the first $20,000 was taxed at the very low rate. The next chunk was at the upper rate all the way up to once you got to $200,000 of income. So in many cases, it was very advantageous where a lot of the beneficiaries were already at the high rate of income to leave the funds, to have the income taxed in the trust at those lower rates rather than paying it out to the beneficiaries. And the after-tax money could be paid out to the beneficiaries, but the income rates get split. So definitely a benefit. So they're curtailing that. So the new tax rules will align testamentary trusts with inter vivos trusts. So inter vivos trusts you can set up a trust throughout your life, and that would be an inter vivos trust. And you can do that now for estate planning and other purposes, but an inter vivos trust does not get those graduated rates. It pays on every dollar of income like it's at the very highest rate. So that's what's coming for the testamentary trusts.
Good thing they raised that top tax rate.
Yeah, it's perfect timing. It's perfect timing. So there's two exceptions that they allow. So there's no grandfathering. So if you have a trust, so those of you that know, a trust can exist for 21 years before everything gets deemed disposed of and you have to pay tax at fair market value. So you could have a trust for 21 years earning income at those graduated rates and saving significant tax. It could be in its 15th year of that regime, it would convert now to the flat rate tax. There are two exceptions. The first 36 months of the trust, of the deceased individual's estate, and certain trusts where the beneficiaries are eligible for the disability tax credit. So they, if they're at the high rate and they are eligible for a disability tax credit, they still get the benefit of splitting income with a testamentary trust. But anyone else, now you've only got 3 years. So what would happen is if someone passed away November 30th, 2015, you would have 3 years where you could leave the money in the trust and generate the income splitting opportunities. So November 1, 2016, November 1, 2017, November 1, 2018, you'd get those 3 years. You'd file a trust return, get the graduated rates, pay at the lower rates. In that 2018 year, you'd have a deemed year end from November 1 to December 31, and then you'd be on a calendar basis. That stub year period, you don't get the graduated rate, so you'd pay at the high rate for that period. So this is something to think about with elderly family members, and you're planning with those that you may have been planning on keeping a trust and utilizing the income splitting rules. These will change significantly. So as of January 1, so it's not as good of a deal. And if you do have existing trusts or you know within your family there are these trusts, you want to talk with your advisor about what the implications are. Likely you'll be now distributing that income to the beneficiaries, having them get taxed in their hands rather than leaving it in the trust.
Aren't you also just limited to having one trust in the 36-year period? So you can't have a trust for each of your kids, you can only have one that gets the lower rate?
So yeah, correct. That's a good point. You have to you can have multiple trusts, so you can set up multiple trusts on death, but you can only designate one as the graduated rate estate. So you'd have to designate that on the I believe it's on the terminal return of the person that is setting up the trust on their death. So if you set up 3 trusts, you'd have to designate one. The one would get the 3-year graduated rates. The other 2 automatically would pay at the high rate. So it definitely impacts these scenarios where there's multiple trusts and where there was planning to utilize a trust to hold assets and generate income rather than distributing the assets right away to the beneficiaries. So these are coming through effective January 1, 2016 and will impact every trust. Okay. So just something else to keep in mind with your estate planning or your elderly family members, the estate planning, to make sure you're aware of this when it comes due. So that brings me to the end of the information I have. Hopefully you found this interesting and not too depressing. Like Terry said, there's still benefits and your advisors can still provide value and make sure you're paying as little tax as possible. Definitely want to thank you for your time and attention for coming. And again, want to thank Terry and Justine for hosting and giving me the opportunity. Any other questions or anything? Yeah.